Welcome to This Explainer. Today, we're tearing into Verizon's completely record-breaking second quarter of 2026. We're going to figure out exactly how a massive strategic shift is paying off for them in real time. Let's just jump right in with an absolutely massive number, $13.7 billion. That figure represents the highest consolidated adjusted EBITDA Verizon has literally ever reported in its entire history. I mean, we're talking about a record-setting quarter that fundamentally challenges how traditional telecom giants operate in what is, let's face it, a highly saturated market. And this aligns perfectly with what CEO Dan Schulman highlighted right in the earnings release. He stated that these results provide clear, compelling evidence that their ongoing transformation is driving a structural inflection point across the entire business. So they aren't just tweaking the margins around the edges here, they're showing absolute proof of concept for a totally new way of doing business. To really unpack this quarter, we're going to quickly look at 5 distinct areas. 1, a structural inflection point. 2, their customer-first strategy. 3, surging subscriber growth. 4, record financial payoffs. And finally, 5, their upgraded 2026 outlook. All right, let's start with section 1, a structural inflection point. When you look at their July 24th press release, it becomes pretty obvious that Verizon isn't just reporting your standard run-of-the-mill seasonal growth. They are explicitly emphasizing that a strategic transformation ignited this accelerated growth. So this isn't just a lucky quarter. It's a highly deliberate pivot in how they run their core connectivity business, right from the ground up. Moving on to section 2, the customer-first strategy. Now, for years, you know the drill. The telecom industry's historical standard relied heavily on really expensive phone subsidies, basically paying massive upfront costs to essentially trap customers in a contract. But Verizon is completely shifting away from that. They're making a commitment to long-term retention driven by what they're calling simplicity plans and Verizon One converged offerings. They are out to earn loyalty based on real value and industry-leading programs, rather than just bribing customers with heavily subsidized promotions. This is, quite frankly, a massive paradigm shift in subscriber retention. Which brings us to section 3, surging subscriber growth. And the execution is definitely working. We're seeing 348,000 broadband net additions in this quarter alone. That is a 12.3% year-over-year increase. And this growth is being driven by heavy demand across their platforms. You've got fixed wireless making up 55% of that with 193,000 additions, and fiber making up the other 45% with 155,000 additions. So customers are clearly responding to the connectivity products themselves, which has pushed their total connections to approximately 17.1 million. Digging into the operating metrics, you can see they achieved 184,000 postpaid phone net adds, making it their best consumer second quarter in 5 years. But you know what the truly vital metric here is? They simultaneously drove churn down to a phenomenal 0.92%. That means less than 1% of their postpaid phone customers actually left. When you combine high additions with record low churn like that, you basically get the textbook definition of a thriving, healthy subscriber base. Now for the really fun part, section 4, record financial payoffs. But here is a super fascinating twist. You might expect total revenue to be way up, right? Actually, operating revenue fell slightly by 0.7%. Why? Well, because equipment revenue plummeted by nearly 20%. We are talking about a drop of over $1.2 billion. Now, at first glance, that sounds like a huge red flag, which completely begs the question, how in the world does a telecommunications giant lose over $1 billion in equipment sales but still report its highest adjusted EBITDA margin ever? Seriously, how does losing $1 billion somehow lead to record profits? The answer lies in intense structural discipline. First off, Verizon just embraced a broader market trend. Customers are keeping their mobile devices way longer than they used to. Upgrade volumes are just down across the board. So instead of fighting that trend, Verizon made the strategic decision to drastically reduce their spending on device subsidies. Because they aren't shelling out hundreds of dollars to subsidize every single upgrade, and because they've achieved that incredible step change in churn reduction we just talked about, their customer acquisition and retention costs have absolutely plummeted. All of this compounds into incredibly healthy unit economics. Simply put, less money spent bribing customers to upgrade equals much higher profit margins on the service revenue they collect every single month. And this newly leaner approach translates directly to the bottom line. Their first half free cash flow surged 16% year over year to $10.2 billion. For the second quarter alone, free cash flow was up over 24%. This massive cash generation is exactly why they were able to expand their full-year share buyback target to up to $4.5 billion. It's honestly a masterclass in disciplined capital allocation. And finally, Section 5, Upgraded 2026 Outlook. Thanks to all of this momentum, Verizon has raised its full-year guidance for the second consecutive quarter with a really clean upward revision. They bumped mobility and broadband service revenue growth expectations up to a range of 2.5 to 3%. Adjusted EPS growth, that was raised significantly, going from 4 to 5% up to 6 to 7%. And that free cash flow growth we just marveled at was revised up to a 9 to 10% increase. They are clearly signaling immense confidence as we head into the second half of 2026. Now, as CEO Dan Schulman noted, they're also seeing the emergence of AI infrastructure revenue right on the horizon. With a highly optimized core business, absolutely incredible unit economics, and these newly emerging AI revenue streams, we really have to ask, just how far can this highly disciplined trajectory take them? Could this structural inflection point end up redefining the entire telecom industry's playbook over the next decade?